Let's dive right into this explainer. Today, we're putting on our quantitative analyst hats to conduct a rigorous, no-nonsense stock valuation on Radian Group, ticker symbol RDN. We're going strictly by the data, stripping down the financial filings and core metrics to figure out exactly what this company is actually worth.
Right off the bat, we run into a massive contradiction hiding in the source data. If you calculate Radian's fair value purely based on its free cash flow, it sits at a measly $20.24. But run that exact same fair value calculation based on earnings per share, and it skyrockets to $64.07. And literally sitting right in the middle of this huge tug-of-war is Radian's last closing price of $35.46.
So you have to ask yourself, which one of these numbers reveals the real Radian? We obviously can't just guess here. To find the truth, we have to systematically process this data through a really rigorous valuation framework to pinpoint the stock's true intrinsic value. We've got to tear apart the balance sheet and the cash flows to see what's actually happening under the hood. Here is our analyst playbook for today. We'll define the valuation challenge, run through our absolute, relative, and asset-based models, and wrap it all up with our final synthesis. Starting with part 1, the valuation challenge. Look, Radian's cash generation is honestly a bit of a financial roller coaster. The trailing 12-month free cash flow sits at roughly $115.6 million. Now, sure, that's up 117% year over year, but the 3-year compound annual growth rate, that's actually down 32%. And when you compare that completely chaotic cash flow to a surprisingly steady dividend, yielding nearly 3% with 6 consecutive yearly increases, well, it makes traditional valuation a massive headache. Which brings us to part 2, absolute valuation models. We're kicking this off with the standard discounted cash flow, or DCF model. This is basically the gold standard in finance. The goal is pretty straightforward. You project the free cash flows out into the future, you apply a discount rate to account for risk and the time value of money, and then you calculate a terminal value to figure out what all that future cash is worth to us today. Of course, building this model out requires data, and since standard company filings don't just hand us forward-looking rates, we have to make some sensible assumptions based on market standards. Taking our base free cash flow of $115.6 million, we're assuming a fairly standard 9% discount rate to reflect inherent market risk, alongside a very conservative 2% terminal growth rate to align with long-term economic growth. But here's the kicker. When we actually run these numbers, the DCF model yields a pretty dismal $20.24. Why? Because that recent 32% 3-year decline in free cash flow drags the entire model down. The cash flows are just way too volatile to rely on. Meanwhile, if we look at an absolute model based on its really strong earnings rather than cash, it points to a fair value of $64.07. That spread is massive, and it tells us that relying purely on a standard DCF in this specific case is incredibly dangerous. So, what do? We pivot. Given that the free cash flow payout ratio has spiked to an absurd 119% recently, we desperately need a smoother metric. By analyzing the company's steady 2.88% dividend yield through a dividend discount model and using its highly reliable 4.26% 3-year dividend growth rate, we get a much more stable baseline than we did from that chaotic cash flow model. It proves the underlying business is actually much healthier than the raw DCF implies. Moving right along to part 3, relative valuation models. Let's see how Radian stacks up against the rest of the neighborhood. Right now, Radian is trading at a trailing price-to-earnings ratio of just 8.57 and an even lower forward PE of 7.89. Its enterprise value to EBITDA, which is a great metric for overall corporate value against operational earnings, sits at 6.49. Now, when we compare these figures to industry peers like MTG or NMIH, which generally trade closer to a 10 PE and an 8 EV over EBITDA, it becomes really obvious that Radian is trading at a noticeable discount. So let's just do the math on that. If we apply a very modest 10x PE multiple, again, totally typical for its peers, to Radian's current earnings, the implied intrinsic value per share jumps to around $41.30. This essentially tells us that if Radian were simply priced like an average run-of-the-mill company in its own industry, the stock should be significantly higher than its current $35 level. Okay, part 4, asset-based valuation. Now this is all about ultimate downside protection. Net asset value basically asks one very simple question. What is the company worth if it simply closed its stores today, liquidated all its assets, and paid off all its debts? Selling off the house and paying off the mortgage. What cash is actually left over for the shareholders?
Well, take a peek at Radian's balance sheet, and you'll see it is incredibly robust. They're sitting on a massive current ratio of 5.43, meaning their short-term assets easily dwarf their short-term liabilities. Their debt-to-equity ratio is wonderfully low at just 0.23. But honestly, the most fascinating metric here is the price-to-book ratio. It sits at exactly 1.0. This means the market is pricing Radian quite literally exactly at its accounting book value. Because of that, the net asset value per share is exactly $35.46. And if you recall from the beginning, that matches the last close price perfectly. The market is essentially looking at Radian and saying, hey, we value you exactly for the parts you own today, and we are paying zero premium for any of your future growth. Finally, Part 5, Final Synthesis and Verdict. Putting it all together, a clear hierarchy of reliability really jumps out at you. That absolute DCF model sits way down at $20.24, but like we discussed, it's just too fragile right now because of those volatile cash flows. Therefore, the asset-based estimate of $35.46 and the relative estimate of $41.30 become far more reliable anchors for a financial firm like this one, which relies so heavily on its balance sheet strength. So we weigh these models logically. We discard the low reliability DCF, and we lean heavily into the high reliability asset-based and relative models. Doing that, our final intrinsic value range lands squarely between $35 and $45 per share. This indicates that the current market price of $35.46 absolutely represents fair value. You've got a rock-solid floor at the net asset value of $35 with some very reasonable room for upside closer to $41 or $45 if the market ever decides to start pricing its earnings multiples in line with industry peers. So I'll leave you with this. As you review this data and stare at a rock-solid balance sheet trading right at book value, ask yourself, do you trust the chaotic math of the cash flows dragging the valuation down? Or do you trust that the broader market is entirely missing Radian's true earnings breakout? It's the ultimate analyst dilemma. Weigh the data, question the models, and I'll catch you in the next explainer.